Hello, this is the second episode of Crypto Korea podcast, and I'm very honored to have Aiham, founding contributor at Silo Finance. Hello, Aiham.
Hi, Koyo. Thank you for having me. How are you doing today?
Very good. It's a sunny day here in Europe. I guess the
Great.
same for you.
Yeah, same here. I just got to Paris last night and it's just beautiful outside.
Great.
Yeah.
So today we are going to go in depth about lending and borrowing, the past, present, and future. We will talk about the main protocols, Aave, Maker, Compound, Silo, and others, and talk about technical aspects of lending and borrowing. But before starting, maybe we can start with you. Can you introduce yourself and tell us a bit about your background, how you came to DeFi and Silo?
Yeah. Uh, my name is Aiham. I'm one of the founding contributors of Silo Finance. I focus on daily basis on what I call product growth, is basically generating traction in the protocol and onboarding more users. Um, Obviously, that's kind of like a discipline at the intersection between data, marketing, product, and growth in general. Well, my story with DeFi or in blockchain actually, it started in about the I think the beginning of end of 2015, beginning of 2016. It was stumbling upon Ethereum white paper and if kind of buying into that ecosystem that was quite small back then, right? Pre-DeFi era, buying into it gradually. And having worked for tech startups, I was just fascinated by the technology itself, and I kind of bought into again into the ethos of it. It's like, hey, there's an opportunity for a sovereign human. There's we can issue our own value and we can control our identities or basically towards our freedom as people in a society, right? That was the idea. And but in 20 being in tech startup and having done actually multiple projects never matured to companies in tech. In 2018, we started a blockchain company, an L1. We wanted to do an L1 to do settlements in music. So we wanted Spotify to pay copyright holders like instantly. Back then, we didn't even have a stable coin. So settlements, if you did settlement, you had to issue a stable coin, and but stable coin mechanisms never existed back then. But anyway, so we did that, and for a couple of months we raised some money, but we kind of it was in Los Angeles actually. We could not bring the product to market, unfortunately, because of regulatory issues, and you cannot settle without some licenses and all. And in 2019, I of course it continued being part of the blockchain, but wasn't until 2020 I got started getting into into DeFi with that emerging. I still remember DeFi when it was like $300 million and then a billion, and then people, you know, gradually getting into it. Now, over a year and a half ago, having been part of DeFi for some time, we decided to start Silo Finance, focusing on solving a couple of problems in lending.
Perfect, perfect. That's a great intro, and you're considered an OG actually in crypto standards now. I think anybody with more than 3 years is an OG, and you're great.
Yeah.
So let's go on lending and borrowing. Maybe to start, can you briefly tell us how lending and borrowing in DeFi works in a nutshell, and how do these protocols make money, and a bit of the evolution of it?
Well, the evolution was around, I think, it was actually Compound and ETHLend evolved later to Aave. The Compound actually revolutionized lending. Was the pretty much like an accounting process, really. Lending, what it is just a bookkeeping. Uh, the bigger invention was the idea of you're lending to a pool, not to a peer. Peer-to-peer lending never really picked up. So you, uh, so the the real start for lending was peer to pool. You lend to the pool, and then users borrow from the pool itself. And the system needs to remain solvent all the time, meaning that there's always the borrowers' amounts are backed by enough collateral that such that if there is any incident of user being under collateralized or cannot repay the loan, the system can do something and protect its solvency. So basically, really about collateral liabilities here, just a simple system. And they created then the C tokens and the claim tokens and this really accounting process. So that was really what they did. And then they're pretty much since then, we haven't seen much deviation from, there are lots of flavors of lending, but it was it was pretty much the same. Pulling together multiple assets, put them in a pool, and and let users borrow and lend within the pool itself, and in really simple terms. The biggest that was pretty much it. And then of course ETHLend rebranded to Aave, and Aave it was Aave V1 and Aave V2, and then kind of picked up to where we are today with pretty much again the same principle, but with lots of features uh, uh, designed around giving users pretty much more tools to control risk in lending.
So I think you mentioned an important point that we will talk later on is about the pool. So you have the lenders on one side, you have the borrowers, and lenders do not know in the lending and borrowing 1.0, let's say, they don't know to who they are borrowing. They're just putting their collateral, their money there, and then anybody can permissionally, without any permission, borrow the money. And this is the specificity of the lending and borrowing 1.0, let's say. Now, as you said, that's a standard like way of functioning of these protocols. And then we saw actually, I think there are two important events in the world of lending and borrowing that happened that had a massive impact in terms of thinking of the problems. One was the COVID crash, where actually Maker had huge problems with the liquidations, and then the other one was the bear market of last year, where several severe events happened. We're going to go into the details of those later and what it means for the lending and borrowing, and actually when that's where actually Silo comes in and trying to solve some of these issues. But just try to summarize in a nutshell. Now we introduced lending and borrowing as they came in the beginning. What was some of the problems with this approach of common pool or any other issues that we had in the first years up until last year?
Yeah, well, until now, honestly, the problem is that in lending, because technically speaking, any token asset part of the lending protocol is uh, is borrowable, and it's also a collateral most of the time. Meaning, if you list any token, you accept the risk of that token. You have to accept it as collateral. So back in the day, people didn't understand that, and still they mostly don't. Meaning, if I list today, let's say just Pepe token, if I add Pepe today to Aave or Compound, uh, the governance in by doing so, they're saying we accept Pepe as solid collateral, and this will not create solvency problems for the protocol. Meaning, if a large user deposits so much Pepe, you can the protocol or the governance is saying we can liquidate that and repay the loans that those Pepe users took. Could be USDC, could be WBTC, could be really any token. Obviously, this is not the case today because obviously they list pretty limited number of tokens. So back in the day, people didn't understand that any token poses basically, if you're creating a lending protocol, a shared pool model like Aave, you're assuming all token assets in the system share the same risk profile. They're all liquid, they're all blue chip, meaning that they're super liquid, known, whatever. But once you introduce a little bit less riskier ones, then your protocol becomes as strong as the weakest token asset in the system. So people didn't really understand that. Compound, the team itself, in my opinion, and this is really not trying to criticize anyone or saying, but Compound understood this from the beginning, so they really never deviated from the 4 or 5 tokens they had. They understood that, okay, this is a limit today. We're going to focus on creating a lending market among 5, 6 assets. That's it. Now, Aave, I think they're more adventurous, and I personally like that. But they, with Aave V, we've seen that with Aave V2, they've started listing a little bit more assets that they don't necessarily share the same riskier. Like with, if you remember, like X Sushi, and today X Sushi would never be listed, or even Silo or token would never be listed. And I would say like don't list it. Like among them, it's risky. It's not because of the project. It's just not liquid, not liquid enough. Now, Xsushi turned out to have an issue with the smart contract, and that caused some problems to Aave later on. But people didn't know that for some reason, because if you land, most users, they visit Aave or they visit Silo and they see, or they visit Compound. On the homepage, they see that assets are separated. Each asset has a line on the homepage. They assume that risk is isolated, is separated, but it's not. So that was really the biggest one. And it's still, if you tell me today, if we measure awareness around risk in lending today, I would, anecdotally, I would say 75% of users, obviously probably not like power users in DeFi, but on average, they don't understand the risk of lending. Um, and that's why that's why there's so many forks of Compound, so many of them, and probably fewer of Aave, and they all have users. So the mushroomed, and each version of each flavor, they take a higher risk by listing a white listing more collateral. And so that's pretty much what's been, and it hasn't really changed a lot because users, once they see higher APYs for some reasons, and rewards APY plus deposit, just hijack their rationality. It's like, okay, let's ape into it. What's gonna happen until something happens?
So about that, maybe to go deeper in the understanding of what would be the risk of a shared pool, let's consider the Luna case. And so Luna was super liquid, it was a reputable project, but let's say that you deposit and there is a pool on Aave. I don't know if it was the case or not. Compound or Aave. Could you deposit Luna and then borrow USDC or something like this?
No, I think they didn't accept it. I think on Aave, if this is the TUST, that was the name, right? The TST, was it TUST or USD? I forgot really. That EST, EST was in the pool, but it was not. You could borrow it, but you can use it as collateral, if I'm not mistaken. But no, you couldn't do that.
But let's take just a thought exercise. Imagine that it was the case that you could deposit Luna as collateral, and then the thing that happens, and Luna goes to zero, and so you have all this Luna put as collateral in the shared pool, which is worth now a zero. Now, what is the risk here for others who are, who did put other collaterals, etc.? What kind of a risk
Right.
are we talking?
First of all, we need to look at the moment that incident happens, how much those Luna depositors have borrowed already from the system, right? Let's assume they've borrowed $100 million, but they're probably of multiple assets, right? They probably borrowed stablecoin, ETH, whatever. In that moment, because Luna crashed, they don't have any incentive to repay the loan. So that money is lost. So immediately the system is not solvent anymore. Meaning you've given $200 million of loans and you only have $100 million of collateral that you could liquidate immediately. So the system has a 50% of its hole in it. like a bank basically, and that's it. It's done. So you need to recapitalize the system. I mean, Aave, yes, has probably like 30, 40 million in kind of like the system backstopping it, such thing, but that's not enough because that hole is just massive. It will kill the collateral. The protocol, they have to redeploy it basically and get new users, new deposits, and everything. But that's in the moment that it happens immediately. But then from the moment it happens to the moment that you could delist Luna, prevent it from being collateral, meaning preventing new users or existing users from taking more loans. That depends on the governance. That depends on how fast they could react. In Aave V2, that takes like about 5 to 7 days, I think. Uh, they really couldn't probably do much. Like, and then I don't know how big of a hole that would have left if that was the case, obviously. So yes, because well, obviously, so it's something is really similar. You have a house, you take a loan against the house, and all of a sudden the house loses its value for any reason. I don't know. Let's say that Detroit in the 60s, all of a sudden that house, this whole city is not habitable anymore. People left, the property price crashed. Why would you repay your loan if you took money? Well, obviously, we have a legal framework here because the bank can come after you even individually. Well, in DeFi, we don't know who you are, so you'll never repay your loan because your collateral just lost its value. So back to your the example with the Aave or Compound, if yes, if Luna, if that was the case on Luna, I think users would have kept borrowing and borrowing more because you could arbitrage it, right? For so many reasons, you could buy it like cheaper and go deposit, and you would deposit knowing you would buy knowing that that's your own exit liquidity. But basically, Aave becomes an exit liquidity for those users because you couldn't redeem Luna anymore, right? Right, redemption probably posed, whatever. So the only way is to borrow against it, and you would just drain the entire protocol. You would have drained it completely. Yeah,
And that
yeah.
would affect all the other people who are not even actually have anything to do with Luna, because then, so for example, something that I know that happens during the COVID crash was when the maker DAO had this Black Thursday, when liquidation couldn't happen when on that day the gas fee was really high, and so liquidation didn't happen, and some people were actually using this opportunity to go and actually get
Yeah,
free
absolutely.
collateral, kind of free ETH, etc., for nothing at all, and then because the auction, there was nobody actually in the auction to have a higher bid, it was accepted, and that created a very bad debt for the system.
Yes,
And
that's
this
true.
bad debt, and the result of that was that DAI was no more collateralized. So and the result of that was that to bring it back to the the peg, they had to mint a huge amount of maker, because that's the process that they have, the
Right,
MKR token. And so there was a crash of 60% on that specific day just on maker, because they had to
right.
mint so much. And so this is a problem that will and that creates with bad debt.
Yeah. It's a different problem though, a little bit different because let's assume that uh, DAI depegged to 70 cents, right, and stayed there. Well, the problem would have solved itself because if you minted DAI against ETH and you had no uh, uh, ETH going up would have fixed the system itself, recapitalized the system because collateral would have increased like so much since then. Because it was I think $250 back then, the ETH. I'm not sure, but right now it's increased so much. So that would have and DAI would have gained its peg. It's slightly different situation where you know that the project is going away and there's no way you can fix the problem other than just depositing this so much money in, and I don't think Aave, the token itself, can backstop that the whole yeah. Yeah.
This gave rise to Silo and Lending and Borrowing 2.0. Could you tell us a bit about Silo and what problems is addressing?
Yeah, so it's a flavor of lending uh, focused on fixing two problems in general. Number one, why don't we have lending markets for virtually any token asset? That's number one. Number two, how can I manage my risk better? I'll give you an example. That was our thinking, by the way, when we started this. So if I have USD, let's say back in the day, Aave V2, it had XSushi in it, and XSushi would have actually drained the protocol when they discovered the issue. But XSushi, you had Ampleforth, I think their stablecoin. They had so many different collateral assets. If you are a USDC user, you deposit USDC, you become a lender to all these token assets. So because anyone could borrow your USDC, so you cannot really manage the risk, right? You cannot say, for example, I'm going to lend my USDC only to WBTC, ETH, and USDT. You cannot say that because the moment you deposit in the pool, because it's short pool design, you become a lender to any whitelisted asset in the moment and maybe in the future when they add new crypto assets to the pool. So you cannot manage risk. You cannot say, for example, I have $10,000, 10,000 USDC. I'm going to give 5,000 to ETH, 3,000 to USDT, and 2,000 for W. You cannot do that. So that was it's a huge problem because of exactly the problem that we talked about. Because these Aave is very responsible community and governance. Same thing about a compound, but in other lending shared lending protocols, the shared pool lending protocols, they can go aggressive. Sometimes they list yield-bearing assets and LP token that can be manipulated, and we've seen that so many times. So these two problems. So markets for all token assets. Second, how do you segregate risk? How do you give users more a better way to manage risk? So we've created Silo. We said, well, and obviously back then it was Rari Fuse pools were also very popular. So that kind of gave us the a better idea how to do it. So these are kind of the pioneers we're talking about. So we created this isolated lending markets. We thought, well, let's create separate pools and let lenders and borrowers use these pools to fulfill this borrowing and lending needs, and you just match them, basically. Just match them in a segregated way. So today, for instance, Silo on Arbitrum, we have about 30 markets. All these markets has USDC. So if you have USDC, you could choose to deposit them based on your understanding or assessment of risk. You can say, our token is very liquid. I'm gonna deposit USDC, and if ARB users deposit ARB and borrow my USDC, I'm fine with it. Accept the risk of that token. You also have another markets to do that, and each market pays slightly different rate because we have, this is another benefit of what we did, because we can implement interest rate curves for USDC, different ones, because we, technically speaking, we have each pool is a small Aave, basically, so we can have that luxury in we can optimize the curve. Exactly. In Aave, they cannot do that because USDC is just one token, and any other token can borrow it. So that's why they unify the rate, just one rate. And again, this is really just because they assume all token assets in the pool have the same risk. So if you put up WBTC collateral or ETH collateral to borrow USDC, you're assuming that WBTC and ETH have the same risk profile. So why would a borrower putting up ETH collateral pay higher than WBTC or the opposite? Why? So you just pay one rate. Yes, so we solved this. We've been trying to solve this problem. So isolated lending markets, any token asset can have a market, and now this market is not functional unless there is someone willing to give you USDC or ETH in our example. So we've created a way to create money markets for any token assets, but each market must have ETH and USDC in it. So this is a requirement in the protocol right now.
So it's just USDC and ETH, and this is for all the pools, and then the the volatile asset, if you want, can
And the
change.
base assets.
Yeah.
Exactly, and the base assets. So we have, for example, an isolated lending market for ARB, GMX, DOPEX, GNS, all these base assets. And in each, what we're seeing in each market, USDC users deposit USDC in varying amounts. Some users are comfortable giving USDC to Omami users, for example. Omami pays about 40% on USDC because it's considered risky. And USDC users are comfortable with the risk of Omami. And Omami has different risk profile from ARB, for example. Now, yes, we solve the problem of risk. Right now, if any token in the protocol, let's say, cannot be liquidated for any reason, like either, and there are so many reasons you cannot liquidate. Lack of liquidations lead to bad debt for sure, most of the time. But there are multiple reasons for that. Reason number one, like you said, sometimes like the token asset is liquid and but you cannot liquidate because of gas issues or technical issues or so many things. That's number one. Now, obviously, with ETH, it's a problem that resolves itself because if it goes up in value, basically you solve the problem. So that's number one. Number two, the token asset just all of a sudden has no value, like zero value because the project crashed. So you cannot really, we can't solve the problem. Three, liquidity dries up for some reason. Either, again, could be sometimes related to the project suffering from issues or liquidity, drying up. Remember, like with Luna and UST, there was bridge tokens, right? If you had some bridge issues, bridge hacked, well, there's no more collateral backing the bridge. So we've seen that actually so many times, unfortunately. So that could be one of the problems. Um, back to this. So if something happens to a token and you cannot liquidate, it does not impact the system. Only USDC users in that specific market suffers. And you could, in that case, you would just archive that market, deprecate it, and deploy a new one with a new system, basically.
Absolutely. And one of the selling points of Silo is that it has a lot of, you can borrow any assets. This is one of the selling points, unlike Aave and Compound, where you have a very limited set of whitelisted assets. Is this permissionless, or is it something that is managed by your protocol or by the DAO?
This version of the Silo V1 is not permissionless yet, meaning that you have to ask us to deploy a market for you. We usually deploy markets for really any token assets except token assets that are not liquid. There's so many token assets that are not liquid. So and that's a limitation for us. And really for any lending protocol. The problem is that liquidity is the base layer of anything in DeFi. If you don't, that's why we always obsessed with AMMs, right? Or like any variation of a DEX, it could be AMM or order book, whatever. We're obsessed with it because liquidity is everything. If you don't have liquidity, you cannot ascribe a value, or you cannot really value a token asset. You cannot liquidate. You cannot create a price oracle, and then all of a sudden the token. And there's so many tokens assets like that because many projects, when we talk to them, they undervalue the need for liquidity. It's also, community. It kind of brings people together if you have a lot of liquidity, right? And borrowing is part of liquidity building as well. One of the benefits. I mean, but yes, you need to ask us to deploy a market right now, and if we can't find a secure way to read the price of the oracle, the price of the token, if the token is not liquid, we cannot liquidate, and we know it cannot be liquidated, we might just usually say no, we can't. But in the future that might change. Yeah.
I recently saw that you Pepe is actually available on Silo. You can use it. Is it and Pepe is liquid because it reached actually 1 billion in terms of market cap. Are you looking at a specific threshold when you want to create a pool in terms of liquidity, or is it specific on the projects, the type of projects?
Right. Um, well, the market cap is not what we look at. It can be misleading. So we look at how much liquidity is available in DEXs. Because in liquidations, and back to the Black Thursday event, you needed that liquidity to be on DEXs, not sexes. So you can liquidate instantly. Number one. But there's also now with Uniswap v3 or the similar to Uniswap v3 where you could have liquidity ranges or liquidity deployed under different ticks. If you look at Pepe or I'm not talking about Pepe in general, or you might see, oh, this token is $20 million liquid. But if you look closely, you might see probably $18 million just on the base asset, not with ETH. There is not ETH depth or not USDC depth to liquidate. There's a little bit, or it could be in price ticks far, far from the market value, which puts it away out of range for liquidators, and meaning you cannot liquidate. So technically, what we look at slippage when you liquidate. So when you liquidate, if I'm liquidating $10,000, well, how much price impact that would reduce? Negative price impact. Is it 1%, 5%? Can you liquidate $1 million with 1%? That's really the success metric we look at. I mean, look at, for example, like highly liquid assets like staked ETH. You could liquidate probably $500 million with little price impact, right? Negative, so no issues. That's super liquid. So we look at that actually.
That's very interesting. So you look at the distribution of the liquidity, not just one
Hmm.
number, which is determining
Now
the
one
total
number,
liquidity, but the distribution of liquidity,
correct?
specifically that when there is liquidation, it means that there is sharp drops. So you want to have liquidity where, the in the ranges that,
Right.
are
Okay.
below the current prices.
Yes, that's just to honestly just to guide our decision, but it's really not even enough because if you really need to assess risk in an accurate manner, you would also consider Black Thursday events where everyone is liquidating. It's not just you, right? Because liquidity can dry up like in minutes. Because you're liquidating, uh, Maker is liquidating, Aave is liquidating, every single, right? CDP, like I should say, everyone is liquidating, so it's going down, down, down fast, and that's why that's how bad data accrues actually. Cascading liquidations is a massive one, and it's very difficult to simulate it. And sometimes, if you simulate it, you end up like in a position like Compound's team probably, where like, oh, we're not listing anything other than these five.
Yes, which is a respectable approach because
Yes, of course,
it's an approach to risk management actually.
it's true.
Very good. So, in terms of Silo's single pool design, what are some of the impacts and consequences in terms of some of the metrics that people usually look, for example, loan to value or this kind of stuff? How does it impact compared to the competitors?
You can have higher uh, max LTV, meaning I can afford to give you higher or larger loans against your collateral uh, because risk is not systemic. Um, that's one of them. Same thing, of course, with liquidation threshold. You can have a higher one. You can have customized interest rate model or configurations, meaning for riskier asset, USDC lenders can earn more because I'm taking more risk. Rarely fused pools did that really well. in some they had one of the or actually all their fuse pools were they implemented very steep um, configurations for stablecoins. Yes, we would allow you to borrow against your LP token, but you'll have to pay 15-20%. But that was during summer, though, DeFi summer, so people didn't care much because everyone was farming. Um, so that's the third one. These are the positive ones. The negative ones, you also fragment liquidity, meaning USDC, and that's one of the drawbacks. That's why Silo has not grown to 150 million or 200 million dollars. If we had something similar to Aave, we would be actually at that level. So, um, and this is something we need to figure out, and we're trying to actually figure it out. We can talk about this, but you fragment liquidity because ETH right now is fragmented across 13 markets, not just in one big pool where everyone could borrow it. Same thing for USDC. This means the two consequences. We, at this level, we cannot cater to large DeFi users, those users that borrow in millions. We cannot fulfill those orders. You could, if you had $10 million today, you could borrow $6-7 million of another token on Aave, easy, or even much, much larger. Talking about crypto funds or like large net worth users and or even developers that develop strategies on top of Aave. They deal with such numbers. Silo, although much safer and much more modular for them, but they don't have enough depth. Like for example, on Arbitrum, the largest market that we have is probably $5-6 million worth. With Arb, there isn't much USDC in it. Probably there's a few millions, but that's not 10-20 millions. So we think that there are some solutions to that, but that's one of the problems that this isolated lending approach creates.
Absolutely. Um, when you deposit in a silo pool, there is a warning message with several points. One of them says, quote, we rely on third-party oracles that may be manipulated or report erroneous prices, resulting in the loss of funds. The protocol has no way to track oracles or prevent it. Can you elaborate a bit on the systemic risks brought by oracles and what could be done and what Silo is doing against that?
Well, to be honest, with you, we have no control over this. Just in a simple one, I'm talking about not a custom one. So, let me start with the major price providers. We call them price providers of oracles, like Chainlink or DIA or DIA, if you wanna call it that way. On the rest of them, um, the problem is that they have their own systems, closed systems. They report a token price. They aggregate data sources from their node operators or certain way, and they provide you with a price. And you have to trust it. There's just no way around it. You have to trust it. Maker, for example, they have their own Oracle setup. They don't rely on Chainlink or anything like that. That costs them millions. People don't know that. Tenth of millions likely, but they're independent. They don't care if something goes wrong with Chainlink, and things can go wrong with Chainlink. People don't know that, but I know it can. They're a phenomenal project and rarely happens, but it can happen. Um, but they want to be independent. But anyway, so we don't have any control. So if you tell us, for example, USDC price is 0.999, okay. If you tell me it's at 60 cent right now, I'll tell you, okay, sure, whatever. I don't know, honestly. So that's we have now. Of course, we use also custom oracles that we create, and those are specifically right now for the Curve LP tokens. If you go to the Curve LP token silo on mainnet, you would see that we've come up with a methodology, we've audited, and it protects against manipulation, and it works fine. But that's a custom oracle, but still the oracle uses Chainlink in it. It has some filters, whatever, but it does this, yes. It's still dependent, absolutely. And that was one of the biggest problems that Curve faces today with Curve USD. They don't want to be dependent on Chainlink because you could mint Curve USD with WBTC, but how do you read the price of WBTC? So you can rely on the price of their own because there are AMM, so they technically speaking they have the price of WBTC, but they have to create some ways around it to protect against manipulation. So yes, we the lending protocols we're dependent on two things: liquidity. If it dries up, goodbye, say goodbye to the pool. If we rely on oracles, if someone manages to manipulate the price of oracle, also goodbye. There are no ways right now for it. Now in the future there will be ways against protections, against something like that. Circuit breakers, we're talking about that, but I think we're a couple of years away from that. Circuit breakers, like breakers, yeah, exactly. Like if you see like an unusual outflow of tokens, let's just lock the system or something like that. Or you see like a weird or kind of flexible loan to value or flexible caps on your pool. For example, if all of a sudden a token asset loses liquidity on chain, like lower it's don't allow users to borrow or something like that. But this is extremely complicated and not those kind of like future things that we've been reading about, but we've thought about many times, and so many of them are just not possible because they can be gamed easily.
Yeah. Yeah, I was discussing on the first episode with Mark from Banker, and he was saying that the takeaway of the bear market of the last year is to take away systemic risk from your protocol. And he actually mentioned about Chainlink, and so the trend that you're currently seeing is that DeFi protocols are still heavily relying on Chainlink, and there is not a lot of development to go away from that model right now. Is that correct?
And oracles in general, yes, but Chainlink be the premier provider, yes. The Oracle less lending, we've been hearing about that. Obviously, Uniswap v4 hooks can enable something like this, an Oracle less. Um, uh, so, but it's still. Personally, I'm not knowledgeable much on the topic to provide like really in-depth analysis of it. But yes, the problem is not about Chainlink and other providers. About do we use an Oracle or we don't use an Oracle at all? So Oracle-less system. That is the biggest question. I honestly don't see a way around this right now. We have to use oracles. And doesn't mean that oracles can be manipulated all the time. I mean, actually, oracles on generally speaking, they're stable. Um, but these oracles like hmm?
It's always about the tail risk, like what if one day something bad happens, right?
um, it's about liquidity and where it is concentrated. That is a problem. If you give me like a Uniswap v2, not v3 Oracle, it's almost impossible to manipulate it. It's okay.
So I saw that on some of the silo pools, there is like the chain, because you actually specify very transparently what is the oracle that you're using. On some of them is the chain link, and on some of them I've seen also Uniswap v3, where you're fetching the price.
Yes.
Is this some sort of diversification of that risk? What's the strategy here?
Um, yes, we display labels, and we also this is a UX flaw that we have. You also, if you hover over the word Oracle, we even give you the link of the Oracle itself, which is a smart contract. Um, no, not really. We use Uniswap v3 only because we cannot find a price feed on Chainlink, and Chainlink has uh, strict requirements before they give you like a feed, or we can find another oracle, honestly. So we use Uniswap v3, and Uniswap v3 oracles, we set them to be a 30-minute to app. Uh, um, time-weighted average price set to 30 minutes. It means that it doesn't mean that it cannot be manipulated because it's simply 30 minutes. No, it means that it just becomes very expensive to manipulate it relative to the gains that you could get from manipulating it. So yeah, it's basically a geometric mean of the price that the Oracle Uniswap v3 implements. So yeah, we usually look at liquidity and how it is concentrated. If it's in a broad range, and we know that liquidation cost of manipulation is very high because any oracle in the world can be manipulated. It's just about how much you're willing to spend. Um, and then we use that feed. But once we use it from that moment onward, we cannot track it. There's no way because liquidity can migrate from one tick to another easily overnight, and liquidity can migrate. We actually have some issues where the entire liquidity migrates overnight from Uniswap v3 to some new DEX because they give them incentives, and and this becomes a problem. And right now we have so there's no way for so the moment, for example, the Chainlink releases a new we switch. For example, right now the RPL Rocket Pool governance token has just gotten a Chainlink feed, and we use Uniswap v3. It's a very liquid market. It's resistant to manipulation, so we're good. But we're switching to Chainlink hopefully when we have some development resources. Yeah, oracles are scary, man. It's scary. Yeah, scary.
So your growth lead, and I guess one of the things that you do is focusing on customer acquisition. I want to ask you about some of the metrics that, as a protocol, you try to optimize because users, usually both lenders and borrowers, are trying to see where they can get the best rates, yields, APYs, etc. And there are analytical tools where you can see actually who is providing better rates, etc. Is this something that you're? I mean, it's also a competition, right? There are other actors, etc. Is the rate of the pool? Is it something that you actively try to optimize, and is it a key metric for you, or are you considering other factors? We mentioned about risk management, which is very big for Silo, and there is also the LTV and other stuff. It's not the only metric, the APY, but is how important is it for you as a protocol to offer competitive APYs?
I think it's very important, but not for every user. So if the variance is little and you know that you're gaining this risk isolation, it's a feature worth paying a little bit higher for. That's for some users. Other users, they don't care. They're absolutely degen. They don't even probably understand that what risk isolation is. But if you look at our protocol for ETH in general, we set the interest rate curve for ETH is pretty much, um, I would say, in line with competitors. So yes, we definitely look at that. But there are other factors as well. Like if you're paying even higher rate, but you're earning some rewards on top, so you're okay. Rates fluctuate, so it's also okay. Some users have considerations around risk, sharing risk in other protocols. So if you're reputable a protocol, you might justify pay a little bit. We've been on the market for 320 days. We're mutables, for example, so that gives probably some of signal some trust to some users. But we definitely, one of the metrics, so we look at the rates. Yes, we look at the rates. We just recently started optimizing rates for riskier assets because assets, those are, you cannot borrow them from other place. We're not trying to just hike the rates because of that, but it's lenders taking more risk. They should make more from that. So that's something we look at. Um, what else? We look at you mentioned success metrics. I don't really TVL is a great metric, but it's also misleading because you have protocols that have half a billion in them, but you don't see much borrowing activities. So for us we will look at right now we're looking at 35% of TVL borrowed on Arbitrum, which is probably a good metric. We look at the length of loans, like how many days, and users usually like borrow in weeks. So this means that you've got some kind of like stability in the system as far as the borrowing, because lenders like that. They don't like to earn 5% a day and then the next day they earn 1% and then 3% and then 7%. This consistency is important. User acquisition is extremely important for us. We look at where they're concentrated. So we see lots of concentration in ARB token because, well, ARB token is highly, because of airdrop, a lot of users have it and I like to leverage it. And obviously you see a lot of users holding it because they believe that this, you know, the L2 can grow. So these are the success metrics we definitely look at. As far as like monitoring rates, we don't have really a system. Every month we see like we look at competitors, we look at different ones, but then we try to see if there are needs to adjust rates. So for example, right now I think ETH should also uh, have probably a different interest rate curves for some assets. So we try to look at, okay, how do we adjust it? How do we optimize it? Yeah.
Is this a dynamic system where it's done automatically based on supply and demand, or is it something that the
No, no.
team thinks about and considers when to change?
Yeah, no, no, not really dynamic at all. We usually start with a proposal and we say like, hey, we're gonna change the interest rate model or configuration for this asset. The newer one will generate this much, and then we create a transaction to upgrade that, and we leave it for a few days for, you know, if you want to take action, if you want to exit the system, for example, you might think it's too expensive. But yeah, we tend not to change that often, probably like maybe once a year or something.
Mhm.
Yeah.
Um, After the severe bear market of the last year, both Aave and Compound released V3, a V3 version. I looked at the Compound V3 and some of the new things that it brings, and I will just mention them. The yield is only received in the base asset, which is USDC. Collateral assets that are supplied do not earn interest at all. So you can
Hmm.
just actually borrow, but you will not
Right.
earn any interest on your collateral. You can no more be both a lender or borrower in a single asset. So if you deposit USDC because you want to earn on that, you can't
Yeah.
borrow. And then also the single borrowable asset that they have implemented, meaning that your collateral remains your property. I want to know what do you think of these changes as a silo? Do you think that it's a move in the right direction based on what we saw in 2022? Is this bringing them closer to silo, or I mean, you still have the single pools that they don't have, but what do you see? What do you think about this
Right.
evolution?
It, it's really not it's actually not lending. Pretty much, it's pretty much like abracadabra does with mem. But of course here you borrow USDC, you don't mint it. But technically speaking, this is closer to maker. Um, you deposit a base asset and you can borrow USDC. But if you are this USDC users, you're also exposed to all the tokens in the system, right? If you deposit USDC, well, it's a shared pool, right? You're exposed to if borrows it, that's okay. If WBTC, but so that's why they cannot add a long tail. It's not risk isolated on the USDC side, and on the base asset side, it's nothing because you really, as a USDC users, you cannot borrow these base assets. So that's why they have two versions of Compound V3. They have the ETH version and they have the USDC version. If you only want to borrow ETH, they give you a version of it. If you want to borrow USDC, you're given. So technically speaking, uh, I honestly, the only thing that provides from a they manage risk a little bit better, little bit, but they're far from risk isolation. Um, they just allow you now. Aave can go a little bit aggressive on adding assets that can borrow USDC, but they cannot go far because USDC users will also be exposed to the risk of all these base assets. So be, so they created a risk isolation on the base asset side, but it's really meaningless because you cannot borrow it. You cannot borrow these base assets, but it's still a shared pool on the USDC side, right? Yeah. So it's one rate. Yeah, it's exactly. So it's technically speaking, it's I honestly speaking, I don't see any value in it. I see Aave v3 much more valuable because they created two separate solutions. They created the shared pool model and they created also isolation mode, and they're trying to implement their own stablecoin in those isolation mode. It's still capped. It's still they have to cap it. It's still also limited to um, that. So it's also governance intensive. To be honest, one of the riskier things if governance fails to react or whatever. This is my view, but these are not like for full risk isolation is a feature in Aave v3. It's not very well, like not pretty much used, but in Silo it is. It's a protocol design. It's not a feature. It's the protocol design. It's designed that way.
Now let's zoom out a bit from lending and borrowing assets and see a bit talk about the future and what's ahead. One thing that I would like to ask your opinion on is about the strategy on going on multiple chains, etc. So, for example, Compound is multi-chain, is deployed on mainnet, Polygon, Arbitrum. Silo is also multi-chain, is you're on mainnet and Arbitrum. Um, this creates opportunities because you can attract new users on new chains, but it's you also mentioned about the problem of liquidity fragmentation. What do you think is the future in terms of protocols? Not necessarily talking just about lending and borrowing, but focusing more on those. Uh, is it more cross chain? Is it more multi chain? Now, layer zero is coming and is bringing some innovation. What do you think about this? Communication between blockchains and the evolution of it.
Right. So when you say, just to understand, when you say multi-chain, it means that they're completely separate ecosystems, like Solana and Ethereum, right? Right. Yeah. And they don't talk to each other. Right.
Yeah, they don't talk to each other. They're just deployed on two different blockchains.
Right. Yeah. Um, I haven't seen yet like a specific use case for a blockchain. Uh, I think both. I think the future is probably both. I mean, if you manage Solana is a very strong ecosystem still, despite everything being said. But if you manage to have that, which is quite difficult to build, I think that's great. It's honestly the same pretty much with users from a user standpoint. To some extent, it is good. I see it as a mainnet user and developer on mainnet. I'm more of a kind of believer in the mainnet like Ethereum future, including all the side chains and L2s, of course. I think the systems like what we're seeing more interoperability and more cross-chain solutions. So one day you could, from a lending standpoint, you could imagine a future where you could safely deposit on one chain and borrow on another chain. Safely, I say, because this is possible today, but it's not safe at all because it uses bridges and it can bring down the entire protocol. So that's why we haven't ventured into that. It's just not possible to do it without introducing systemic risk, which we boast saying that we try to solve. So we cannot just introduce something that would completely kill your unique selling proposition. So yes, with layer zero and with this solutions, they're progressing really, really fast. And I think one day, yes, I think will be abstracted away from the user. Will be the user if you're within the mainnet ecosystem. Doesn't matter EVM or L2, probably likely L2s. You probably don't care. you don't care where this USDC comes from, right? Especially if more and more projects kind of like try to become like, yeah. So I think cross-chain is something that certainly, but doesn't mean that there won't be other protocols, other ecosystems. Um, yeah, I actually see it completely possible. Why not? I don't see much happening, of course, as far as interoperability among ecosystems, but within the one, yes, that's exactly where we're going. I would like to see more L2s actually talk to each other. Like that would be interesting. Like Optimism and Arbitrum, for example. Yeah, I like these two ecosystems. Really strong developer ecosystem, and that would be great. And it would be remove a lot of issues from us as well. Like for us, like it's a lot of work in deploying and managing and all. So
Yeah, exactly. In terms of innovation in the lending and borrowing landscape, I mean, the idea behind the lending and borrowing is pretty simple. And so we had Compound and Aave, and then Silo, who brought some innovations. There are a lot of new protocols, as you said, that are forks of Compound or Aave that are deploying on new chains like Arbitrum, ZK, Optimism, all the other new chains. But are you seeing some kind of innovation, like some new protocols? I'm talking more about newer protocols doing anything special?
not really, no, no. I have not seen since it seems that Compound, it seems just Aave actually. Aave innovates a lot. Aave innovates a new version, and then it gets people take kind of like take some features from it, and then probably deploy a little bit of a variation of it. It hasn't happened for Aave v3 yet. We've seen it with Aave v2, but mostly Compound. Usually they take Compound and they stretch it a bit. Not necessarily as far as features. They probably innovate a little bit on tokenomics, mainly around appreciating the token price, but add they whitelist token assets aggressively, and that defeats the purpose, sometimes recklessly. Um, yeah, you see some users maybe implement some caps on borrowing, but what happens with these forks? The problem is that's why we haven't forked. I mean, if Silo is not a fork, it's a new code, because once you take and that's, I'm quoting from our engineers, by the way, I'm not an engineer. Once you take a code, you're not the author of that code, so you don't really understand it fully. But you start stretching it, start adding, for example, caps here, or some requirements there, or you try to implement circuit breakers, like, oh, I'm not allowing you to withdraw after one until like there's a few blocks, or whatever those tiny features, and that sometimes introduces a lot of risk because you just forked something you don't understand. When you add a feature, it changes the entire protocol. That is, they don't really understand that. So I'm not seeing lots of features, to be honest with you, as far as the core protocol, but tokenomics, yes. Like Radiant, for example, on Arbitrum is a large one. They innovated a lot around the tokenomics. Like they charge hefty fees, and they see that those fees accrue to 75% to the user, I think, but they charge hefty fees and something like that. But technically speaking, as far as borrowing, they have five assets, and pretty much it's a compound fork. I think it's a compound fork, but I don't honestly know, but very much like that.
Now, let's talk about the future and lending and borrowing. Arcade is a DeFi protocol where you can lend NFTs, and you can actually put real world assets like a Rolex watch to lend to have DeFi loans. Goldfinch is another protocol in the real world assets where it allows anybody to be a lender. What do you see as integration of real world assets with the lending and borrowing? Do you see any opportunities uh, helping the adoption of DeFi through real world assets and allowing bringing new users who want to lend, who want to borrow, without them
Right,
necessarily being actually DeFi natives, but just for the
right,
services of for the properties of permissionless, etc., that DeFi offers to other people.
right. You know, we've started with this. in 2018 when we did this music startup, one of the ideas was back then, and we had talked to so many artists to tokenize the song. We didn't use the word NFT back then. We just used actually the ERC 721. And the idea was that this is something people don't know. There is a large market for what do you call it, like copyright ownership, like rights ownership, like royalties, because these songs generate royalties, so that's an income, and technically speaking, you can tokenize it, you can lend against it, borrow against it, and etc. So real world asset. The problem is the legal framework. With the Rolex watch. So let's say I'm giving you $5,000. I'm giving you $5,000 against your Rolex watch, right? There's no Oracle. I mean, we both, there's Oracle-less system. I accept the price you value because you probably use a third party, right? That's the easiest system. There's no Oracle for that. We bring a consultant. He says that's $5,000 watch. I'm allowing you to borrow. Uh, you can borrow $4,000 against it, and there's uh, now I'm giving you my dollars, my fiat money or USDC. Well, I cannot. I don't. I'm not paying back the loan, right? So how do you get possession over my watch? But you need someone to do it. So you need third party. This is like a physical asset issue. What if what is the legal framework? How do you enforce that? That's a problem, right? But that's probably a complicated one because it's a Rolex one, but it could be a song, for example. Well, how do you really, but you still need this legal framework. Even if you solve the Oracle problem, if we both agree that this NFT is worth $10,000 and I don't care about the market value, I'm just going to accept that it is $10,000. So if you don't give me my money back, I'm going to be happy owning that NFT. Yeah, you've solved the Oracle problem. And an NFT can be done because I can transfer the NFT automatically to you. That's no problem. But if it's physical asset, you're now highly dependent on regulations. So you need to enforce that. And the song aspect, you cannot. When we back in 2018, our lawyers said stay away from tokenizing a song because that's you issuing a security. Unless you want to issue an IPO for every single song, which is possible if it's a song that generates millions of dollars. And there are actually startups that tokenize and securitize a painting, but that painting could be $30 million, $40 million, and yes, you can sell shares of it. But if it's just a $1,000 song, I mean, you're not going to pay IPO fee of $1 million, right? To file it and of it. So yeah, actually, I see a lot of value in it, but I think I see it peer to peer though, more of a peer to peer setting. So yeah, I think no, I think there are so many assets that you wouldn't mind owning. You wouldn't mind the price fluctuate that much, probably, and the price does not necessarily fluctuate that much. Could be real estate, for instance, very stable. Yeah. No, there are actually so many assets that can. I actually see a lot of value in it. The problem is the legal framework. It's not having, you cannot enforce it. Yeah, yeah.
So let's talk about tokenomics and tokens. It's very common in DeFi and specifically in the lending and borrowing protocols, all of them, to incentivize users by providing some rewards, which is usually the native token of the protocol. My question is, do you think this is a sustainable practice? Where is this? Where is actually the rewards are coming from? Is this real yield? My understanding is that for now it's more of a like incentive, but it's coming from the inflation of the token, which is okay at the beginning for protocols. At early stages they need that. But I want to hear your opinion. Do you think that this is a sustainable practice, and do you think that we still gonna have these rewards in a few years from now?
I'm for distributing for any project distributing 20 to 40 or 50% of tokens to users because you expand you create a community. We community is just invaluable for any protocol. It's extremely hard to do it without emitting tokens and having a token model. I think that's important. So I'm for that. And honestly, I don't see any issues with distributing the tokens, because the issue is if distributing the token does not produce any value, that is the issue. So more users receive the token, but you don't see uh, borrowing, for example, increasing. You don't see more pools starting. You don't see more users using the protocol and more loans being taken, and the duration of those tokens, for example, extend. Yes, then it's a failure. So if the protocol fails to capture value, to create value first and capture any of that value, and at the same time you're inflating, you're issuing tokens aggressively, or could be less aggressively, then that is the issue. So some protocols succeed in that, some don't. You just inflate the token price, inflate um, the you emit tokens, um, and then you just get nothing. That's the biggest issue. But I'm actually all for token distribution.
Yeah. So, in your opinion, as long as the incentives concretize with like real business metrics of the protocol going up, more loans, more users, etc., there is no
Exactly.
problem with because there is a
Yes.
trend that I'm seeing recently with the people saying that most projects don't need a token or we're going for tokenless projects. But the problem is that it's extremely hard to start for a new project without a token.
Absolutely. Unless you have a VC backing you or VCs backing you. Or unless you have VCs backing you. Yeah, if you have like a couple of VCs that pump like $1 billion in the protocol, like Uniswap, for example, is has like a very strong VC backing on top of the success, obviously. Like that, if you can manage that, yes, you don't need a token, but in most cases you do need a token. Actually, you definitely need a token. Certainly, I mean, yeah, if you hear founders saying that we don't need a token, I would stay away from that project as someone honestly speaking, unless they have reasons, obviously, like that. Yeah,
Talking about VCs, Silo is not a VC-backed project, unlike Aave Compound and Maker. So Silo issued a token on a public sale. What is your take on the VC? I see two sides like Pro VC or not Pro VC. Do you see any kind of advantage of going for getting backed by VCs? Because actually crypto allows us to have, to anybody to issue a token and do a public raise or whatever.
right.
um, what are your thoughts about that? The problem
Yes,
I
we
see
did the
with
token.
with, with just
Yeah, go
just
ahead,
to
please.
add on that, the problem I see with VCs is that yes, then you get a backing. In many cases, at least for now, the VCs usually VCs is not just about money; is also offering expertise, services, networking, etc., which in many cases doesn't happen. And in addition, it adds a lot of selling pressure. Sometimes we have seen in the past year actually many VCs who were in bad situations and who had to dump their token. I'm thinking about Near, Solana, and all this kind of stuff, which can kill a project. I would like to hear your thoughts about this.
Uh, and we're not VC backed, and that actually happened to us in a brief period of time. I'll tell you. So it depends on who holds the token. Really, it's not about VC. So yes, we did a token auction on Gnosis batch auction platform, um, except the US. It was not available in the US. We did that, and yes, we did not want to take money from VCs. And I think that back then was the reasoning is that well, what kind of value do they bring? That's number one. And I was proven wrong. I think they bring a lot of value, the good ones, the ones that So I admit that. That's number one. Number two, um, that thinking was like community, just to get users to get you token. Uh, so Uh, and because we didn't want to negotiate, and because they tell you, for example, a lot of VCs tell you, sell us the token at a huge discount and then do a token auction. And in this interim, we will help you bootstrap liquidity in your protocol, get to a level, and then do the token auction, right? We thought like, well, let's go all the way to launching the protocol. We didn't want that. And actually, that proved to be right. Uh, uh, so I say, so I'll tell you what happened after the token auction. A fund ended up owning 30% of the circulating supply in that period of time for 6 months. 30%, just by coincidence, not because they wanted to. I think um, in the token auction, um, not in the States. Again, repeating this because it's important. But anyway, but then they were also heavily invested in the Luna ecosystem, and they had to wind down the entire fund. So they dumped 30% of our token, which was trading at 30 cents, roughly 25 cents, something like that, consistently, because everyone paid a single price, including that fund, including that fund, but they had to dump it over a couple of months, and the price crashed out probably until like all the way down to 2 cents, and then recovered obviously. And a lot of users found it a great opportunity to buy it, unfortunately. So you could be in a situation where a VC, not necessarily a great VC investing, like dumping or selling, or it could be actually someone who got in the auction and they still sold because they, for some reasons, right? And this fund, they dumped the token, not only our token, like everything they had in that fund specifically. So I say, but there are two types of VCs, because since then we've talked to so many. They don't necessarily, they're not investors or something like that, but they deposit money in our protocol sometimes. So we talk to them. Some of them are extremely knowledgeable and they connect you, so they bring a lot of value, and I think they are extremely important to have. But some we have talked to, they're absolutely, they bring zero value. They're no expertise, they're not willing to help, there's nothing really. And a lot of people, when you pitch to them, they promise you a lot. I think there is a circulating spreadsheet in the community that ranks these funds top to bottom. I think it's extremely important to have them on your side, in my opinion. If we had them, I mean, if we had them today, we would probably have like 50 or $100 million just deposited, and just our markets right now are just crying for more liquidity. If we had more liquidity, we would see like 10x the the events, but we're solving this problem slowly, but we're getting there. But yes, definitely get money from VCs if you can, good ones.
Yeah, so that was very interesting point that you mentioned, that although you did a public auction of the token, VCs can still go and buy it publicly like the others, and then they can still
Mhm.
dump it, which will cause an issue of the
Yeah,
token. Talking of which, a lot of tokens in the last 2 years have dropped significantly in price. Um, we see a lot of like similar kind of patterns where, after November 2021, most tokens lost 90%, 95% of their value. As a protocol, like, what is your takeaway from that, and how does it affect the protocol, and what can you do against it?
I don't think you can do much against it, to be honest. Sometimes if the market is going down, the market is going. Your token is going down in value. There's no every token asset is correlated with to ETH. At the end of the day, if ETH goes down, no matter who you are, you're going to go down. So no, that's number one. But the best thing, and it's also a community perception. Sometimes, like, you don't communicate as much, and then you see a token being sold or whatever. I think it's a combination of communication. It's transparency in the community. Um, so everyone knows that, okay, something being done. It's not like no one is working on the project. But how do you see that, right? It's also important. How do you communicate that from a user perspective? Or how do I see it? That's probably what it is. Um, but in most cases, sometimes launches fail. right? You innovate a little bit and it's not working as it takes time. I mean, it took us 3 4 months just to really start growing a little bit, right? So in those 2 3 months, some community were like members were patient, some communities were just simply not patient and putting a lot of pressure. So and selling the token, obviously. Honestly speaking, I think the best way to do it is being transparent and if you can, if you have like a mechanism to offer rage quit function where those people can just redeem your tokens or which is that's why important of liquidity, just create liquidity for the token. If you want to exit, just go exit then, but you have to take a cut really. That's also a good way because sometimes if you don't have that, users get frustrated and they cannot exit for certain reasons, and that creates a problem. This creates a lot of problems in the community.
Very good. So we are approaching the 90 minutes mark. My very last question is about any kind of advice or tips that you would like to share for new protocols, new founders. You mentioned a few things right now: transparency, communication. Anything you would like to share, also based on the experience of the bear market of last year? Um,
Uh, a few things like I can share some learnings. Probably try to go to market as fast as possible. Don't spend much time in innovation. Just innovate probably like one or two features, and fork is very not a problem. But as long as there is a vision for your product, it's just like not creating another fork of compound and I'm listing it. That's not innovation. But go try to go to market as fast as you can. Community extremely important. Over communicate and be transparent. Just bring everything up. Just don't hide anything. If there's a problem in the team, just tell them like, "Hey guys, we have this problem." If there's a problem in treasury, just tell them that. If there's a security concern, just tell them. That's um, the second one. The third one, just patience is extremely important, especially if you're now backed. The third one, fourth one, try to be extroverted as much as possible, like going to events, talking to the protocols, try to partner with them, and it's pitch all the time. It's extremely important. Integrations are very important, and we have realized its importance after we forked on Arbitrum because of so many integrations that we have right now going on. We're friends with almost all the projects on Arbitrum, and that we're seeing the value of that. And obviously, everyone is friendly there. It's just extremely important. And these are kind of like some of the learnings that I have.
Amazing, amazing. Iham, thanks a lot for your time. That has been a great conversation. Thanks a lot.
Yeah, thank you so much, and thank you for having me. I enjoyed the conversation. Appreciate it.